6 months ago, you paid $3 over spot for a Silver Eagle. Today, you're paying $8. In 3 months, you'll pay $15. This isn't dealers getting greedy. This is the silver market breaking in real time. And the premium you're paying is a mathematical signal of what's coming. Let me show you exactly why premiums are exploding. Let me show you the specific mechanisms driving the increase. And let me show you why $15 premiums aren't speculation. They're the inevitable mathematical outcome of the credit crisis that's destroying dealer capacity to source and deliver physical silver. January 2024. You could buy a Silver Eagle from any major dealer for spot plus $2.50 to $3.0. That premium covered the dealer's costs, acquiring the coin from the mint or wholesaler, storing it briefly, processing your order, shipping it to you, and maintaining a small profit margin. The system worked efficiently, premiums were stable, delivery was fast. By March, premiums started creeping higher. $3.50, then $4.0. You might have noticed. You might have thought dealers were taking advantage of increased demand, but demand wasn't the driver. The driver was dealer financing costs. Here's what happened. Banks started increasing collateral requirements for dealers. Previously, a dealer with $1 million in silver inventory could get $1 million in credit, dollar for dollar. But in March, banks moved to 1.15 to 1 collateral requirements. Now that dealer needed 1.15 million in collateral to get 1 million in credit. This reduced dealer buying power by 13% instantly. A dealer financing 100,000 ounces could now only finance 87,000 ounces. Reduced buying power means reduced inventory. Reduced inventory means higher premiums. By April, collateral requirements hit 1.30 to 1. Some dealers saw 1.40 to 1. Buying power dropped another 12 to 15%. Premiums rose to 4.50 to $5 more. Credit lines themselves were being reduced. A dealer with a $50 million facility saw it cut to $42 million. A 15% reduction in available capital across multiple dealers as banks decided precious metals financing was too risky. Reduced credit means dealers can't buy inventory in volume. Volume discounts matter. A dealer buying 500,000 ounces gets better per ounce pricing than one buying 100,000 ounces. Credit constraints force smaller purchases at higher per unit costs. Those higher costs get passed to customers through higher premiums. By May, we started seeing $5 to $6 premiums become standard. This wasn't temporary volatility. This was the new baseline. Dealers needed those premiums to cover increased financing costs, higher per unit acquisition costs, and to maintain sufficient margins to justify the risk of holding inventory in a volatile market. Then in June, the credit crisis accelerated. Multiple dealers hit their credit capacity entirely. They couldn't finance new inventory purchases, regardless of demand. When supply constricts, while demand remains constant or increases, prices rise. In this case, premiums rise because the premium is the price adjustment mechanism in the physical silver market. Think about the economics. Spot silver trades at $24 based on futures markets. But physical silver has real costs: mining, refining, minting, storing, transporting, financing. When the financial system worked normally, these costs were distributed efficiently through the supply chain. Competition kept markups reasonable. But when credit constricts at every step, markups aren't small anymore. Refineries need higher margins. Wholesalers need higher margins. Dealers need massively higher margins. Each step adds larger markup. The premium explodes. Specific numbers. January, spot $24, refinery markup 50 cents, wholesaler 60 cents, dealer $1.40. Total premium $2.50. Customer pays $26.50 per ounce. July, spot $24 unchanged. Refinery markup $1.20. Wholesaler $1.50. Dealer $5.30. Total premium $8. Customer pays $32 per ounce. Spot didn't change. Premium increased $5.50. That's 220% premium increase with zero spot movement. This is financial infrastructure breakdown. Now let me show you why $15 premiums are coming. Not might come, are coming. The math is straightforward. Current dealer credit capacity is declining at approximately 12 to 15% per quarter. If this continues, dealers will be at 50 to 60% of January capacity by fourth quarter. That means they'll be able to finance only half the inventory they could finance 8 months earlier. But demand isn't declining. In fact, demand is increasing. Industrial silver consumption is accelerating. Investment demand is steady or growing as investors recognize the supply constraints. So you have declining dealer capacity to supply physical metal meeting constant or increasing demand. The gap between supply capacity and demand gets filled by price. In physical markets, that means premium increases. If dealer capacity falls another 30 to 40% from current levels, premiums need to rise proportionally to ration the limited supply. Current $8 premiums represent dealers operating at roughly 70% of optimal capacity. At 50% capacity, premiums need to reach $12 to $14. At 40% capacity, $15 to $18. The credit deterioration that's driving capacity reductions isn't slowing. If anything, it's accelerating. Banks see the same market tightness we see. They see volatility. They see derivative exposure. They see risk. Their response is to reduce credit further. This creates a self-reinforcing cycle. Reduced credit causes reduced capacity, causes higher premiums, causes more volatility, causes banks to reduce credit further. But there's another factor driving premiums higher that we haven't discussed yet: delivery failures and sourcing difficulties. Dealers used to source predictably, place order, receive in days, sell quickly, fast and reliable. Now orders arrive 2 to 3 weeks late. Wholesalers ship 60% of what was ordered. This unpredictability forces larger safety stock. But carrying more inventory when credit is constrained means lower total volume. Lower volume means higher premiums. Sourcing failures. Dealer orders 10,000 Eagles, wholesaler confirms, then delivers only 4,000 a week before due date. Dealer needs those 10,000 for customer orders already accepted. Must scramble for alternative suppliers at higher prices with rush delivery. Extra costs. These failures cascade. Wholesalers can't get metal from refineries on time. Refineries can't maintain schedules because credit limits raw material processing. Unreliability cascades to customers. Dealers have two choices: delay customer orders and hope to source eventually, or increase premiums immediately to create buffer for alternative sourcing when primary suppliers fail. Most choose option 2. They'd rather charge higher premiums and deliver on time than lower premiums with constant delays. Premium increase is reliability insurance. The most reliable dealers charge higher premiums because customers value reliability. Dealers offering lower premiums but frequent delays lose customers. Market competition rewards higher premiums rather than punishing them. In this broken market, reliability is worth more than cost savings. Two-tier premium structure emerging. Standard Silver Eagles, $8 premiums. Guaranteed 1-week delivery, $12 to $14 premiums. Customers paying double for speed. Physical silver for immediate delivery is scarce enough that premium price discovery reaches $12 to $14 right now. That expedited premium is the leading indicator. What sells for $12, rush delivery today, becomes the standard premium tomorrow when normal delivery slows further. Now let's talk about the Mint's role in premium expansion. The US Mint produces Silver Eagles, but they don't produce unlimited quantities. They have production capacity limits. In 2024, the Mint has been operating near maximum capacity trying to meet demand, but they can't expand capacity quickly. Building new production facilities takes years. Training new workers takes months. When Mint production can't keep pace with demand, dealers need to source coins from secondary markets or pay premiums to wholesalers who have existing inventory. The Mint might sell coins to authorized dealers at spot plus $2. But if those dealers are immediately sold out, other dealers need to buy from the authorized dealers at spot plus $5, then add their own margin. Suddenly, the customer is paying spot plus $8 to $10 because Mint production capacity creates a bottleneck. The Mint's production constraints aren't going away. If anything, they're getting worse as employee turnover increases and production equipment ages. This means one component of premiums, the scarcity premium from limited Mint production, is structural and permanent. Then there's the international dimension. Silver is a global market. When U.S. dealers face credit constraints and capacity limits, you'd expect international buyers to shift to European or Asian dealers, and they are. But those dealers face similar credit constraints in their jurisdictions. European banks are pulling back on precious metals financing just like U.S. banks. Asian dealers are experiencing supply tightness from increased central bank buying in the region. This global coordination of credit pullback means there's no pressure relief valve. U.S. buyers can't easily shift to foreign dealers to find better premiums because foreign dealers have their own capacity constraints. The premium expansion is happening simultaneously across markets. When I say $15 premiums are coming, I mean globally, not just in the U.S. We're also seeing premiums diverge based on product type in ways that reveal the underlying shortage dynamics. Generic silver rounds used to trade at $1.50 to $2.00 premiums. Silver Eagles at $2.50 to $3.00. The spread was about $1, reflecting the sovereign Mint premium. But now generic rounds are at $4 to $5 premiums, while Eagles are at $8. The spread doubled. This happens because dealers are focusing their limited credit capacity on products with the highest margins and fastest turnover. Eagles sell faster, so dealers prioritize sourcing Eagles, which increases scarcity in the generic round market, driving those premiums higher too. The premium structure is also revealing something about future price expectations. If dealers expected silver spot prices to fall, they'd reduce premiums to move inventory before prices dropped. But they're increasing premiums, which tells you dealers don't expect spot to fall. They expect spot to rise, or at minimum stay elevated. Higher premiums today hedge against the risk that spot prices increase before they can replenish inventory. This brings us to the mathematical projection. Current $8 premiums represent approximately 33% premium over $24 spot. If spot stays at $24, but dealer capacity continues declining at current rates, premiums need to reach 45 to 50% to ration supply, which means $11 to $12 premiums. But spot won't stay at $24 if physical supply constraints persist. Industrial buyers facing long delivery delays will bid spot prices higher to incentivize increased production. Investment buyers seeing the shortage will accelerate purchases. The combination pushes spot to $28 to $30 within the next projection period, according to analyst estimates. At $30 spot, with 45% premiums, you're paying $43.50 per ounce. But wait, as premiums rise, some buyers exit the market because prices become prohibitive. This reduces demand and should moderate premiums. Except the buyers who are exiting aren't the industrial buyers, or the serious investors. It's the marginal retail buyers. The serious money keeps buying, so demand doesn't fall enough to prevent premium expansion. The $15 premium scenario happens when spot reaches $32 to $34 and dealer capacity drops to 40% of baseline. At $33 spot with $15 premium, you're paying $48 per ounce. For reference, silver's all-time high was approximately $50 in 2011. We could reach that level through premium expansion alone without spot exceeding $35. Here's the thing, though. These aren't worst-case scenarios. These are baseline projections, assuming current deterioration rates continue without major disruptions. If there's a disruption, a major dealer failure, a mint production shutdown, a geopolitical supply shock, premiums could spike to $20 or more almost overnight. We saw this dynamic in 2020 during COVID. Spot silver was at $15. But you couldn't buy physical silver for less than $25 to $30, $10 to $15 premiums. That lasted for months, and that was a temporary shock that everyone expected to resolve. The current credit crisis is structural. It won't resolve in months. It will take years to rebuild dealer credit capacity, if it happens at all. So when I tell you $15 premiums are coming, I'm not being dramatic, I'm being conservative. The mathematical progression from $3 premiums to $8 premiums took 6 months. The progression from $8 to $15 will take less time because the underlying deterioration is accelerating, not stabilizing. What should you do with this information? First, understand that the premium you're paying isn't dealers ripping you off. It's a signal of real market stress revealing underlying system breakdown. Second, I recognize that if you're buying physical silver, higher premiums are the new reality for the foreseeable future. Waiting for premiums to come back down means waiting for a credit system recovery that isn't happening and won't happen without major structural changes. Third, if you're committed to physical silver, the cost basis conversation changes fundamentally. You're not buying at spot plus premium as separate components. You're buying physical silver at the total all-in price. The premium is part of the asset's true cost in the current broken market structure. Some buyers are shifting to alternative products to avoid high premiums. Instead of silver eagles, they're buying silver bars with somewhat lower premiums. This works temporarily until bar premiums rise to match coin premiums, which is already happening in real time. Others are buying junk silver, pre-1965 US coins that contain silver. Premiums on junk silver are also rising, but slightly slower than bullion premiums. This arbitrage opportunity won't last. The most informed buyers aren't trying to minimize premiums. They're trying to secure metal before premiums make physical silver inaccessible to retail buyers entirely. When premiums hit $20, a $30 spot price means $50 all-in cost. At that level, most retail volume disappears. The market becomes institutional buyers and high net worth individuals. Regular retail investors get priced out. That's the end game of premium expansion. It's not that silver becomes unavailable, it's that it becomes unaffordable. For most people, at the premiums required to incentivize the constrained dealers to source it. You're paying $8 over spot today, you'll pay $15 tomorrow. And the premium you're paying is the market telling you that the financial infrastructure connecting buyers to physical silver is breaking. The question isn't whether premiums will rise. The question is whether you'll secure your position before premiums rise beyond your budget.